Why U.S. corporate taxes matter. Corporate taxes in the United States are a critical part of your business's financial planning and long-term sustainability. Whether you're a local entrepreneur or a foreign investor, understanding how the U.S. taxes businesses is essential to avoid surprises and maintain compliance. The U.S. federal corporate tax rate is currently 21%, applied to C corporations. However, many small businesses are taxed as pass-through entities, like LLCs or S corporations, meaning profits are taxed at the individual level. Beyond federal taxes, state and sometimes local governments impose additional corporate income taxes, ranging from 0% to over 11%, depending on where you do business. Choosing the right business structure for tax purposes. Your legal structure determines how your business is taxed. Here are the primary options. C Corporation pays federal corporate tax at 21%. Profits distributed to shareholders as dividends are taxed again at the individual level, double taxation. S Corporation avoids double taxation by passing profits directly to shareholders who report them on personal returns. Limited to 100 shareholders. All must be U.S. citizens or residents. LLC, highly flexible. Can be taxed as a sole proprietorship, partnership, S Corp, or C Corp. Partnerships and sole proprietorships. Income passes through to owners, avoiding corporate tax, but still subject to self-employment taxes. Choosing the right structure can result in significant tax savings and should align with your business goals, income level, and investor needs. Federal versus state corporate tax obligations. Every business must pay federal income tax on net profits, but state-level taxation varies widely. For example, Texas and Wyoming have no corporate income tax. California has a flat 8.84% corporate tax rate. New York offers several tax credits but has a base rate up to 7.25%. Some states also charge franchise taxes or gross receipts taxes, regardless of profitability. This is why tax planning must consider your physical presence, nexus, and where you generate revenue. Deductions, credits, and smart tax planning. To reduce your tax burden, businesses should take full advantage of deductions and credits available. Key deductions include salaries and wages, office rent and utilities, business travel and meals, depreciation of assets, software and technology subscriptions. Federal and some state governments also offer tax credits for R&D, hiring veterans, energy efficiency, and more. Planning with a tax advisor can help you identify these opportunities and time expenses to your benefit. Filing deadlines and penalties to avoid. Corporate tax returns. Form 1120 for C Corps, Form 1120S for S Corps are typically due by March 15th or April 15th, depending on the entity type and fiscal year. Late filing or payment can result in steep penalties and interest. Key compliance tips. Use a calendar to track quarterly estimated payments. File extensions on time if needed. Don't overlook information reporting forms, e.g., 1099s. Failure to file correctly or on time can trigger audits and unnecessary costs. Foreign-owned companies and U.S. tax compliance foreign entities operating in the U.S. must pay taxes on income effectively connected with U.S. trade or business. They may also be subject to branch profits tax, withholding tax on payments to foreign persons, and Form 5472 reporting requirements. Proper structuring and expert guidance can help mitigate double taxation and ensure your operations remain compliant with U.S. laws. Conclusion plus expert tips. Understanding corporate taxes is not just a compliance issue, it's a strategy. With the right approach, you can minimize your tax liability, reinvest in growth, and stay ahead of regulatory risks. 3. Tax smart tips for U.S. businesses. Choose the tax structure that aligns with your income and growth plans. Review deductions and credits annually with a tax advisor. Don't overlook state and local obligations. They can be costly.